the age-old question, are tech stocks overvalued? Ladies and gentlemen, this is a common theme, discussion, philosophy surrounding the tech industry as it stands today. And I want to take a moment to listen to professional investors on the bull and bear side of what is currently happening here. And before we dive down into those discussions, just taking a look at an ETF called QQQ, a favorite amongst the investing community, holding some of those top-weighted tech companies, currently up 11% year to date. We got companies like Apple here, guys, up 17%. Microsoft somehow being the golden gem, even finding growth prospects going into this pandemic with cloud computing, currently up 22% year to date. We got Facebook, one that I believe is truly the most undervalued and underrated top 10 S&P company, currently only up 3%. We got Amazon, 41.8%, just dominating the tech industry right now, currently worth $1.34 trillion. And then finally, Google, which is actually flat on the year, which is pretty impressive comparing it to its other tech counterparts. But ladies, gentlemen, before we move forward, you have to keep in mind the discussions we're about to listen to and have are all macro-based, and it is impossible to understand where companies that are worth trillions of dollars, what they are going to do on a bi-weekly, bi-monthly, or even bi-yearly basis. You need to be thinking 5-10 years out from now, so do keep that in mind moving forward. Now, many of you know my opinion, but it is almost impossible to be bearish on these stocks when they are the top weighted amongst Vanguard, BlackRock ETFs, retirement ETFs that just funnel all this money into them. And then on top of that, when Apple is doing $8 billion in share buybacks, even if their earnings and revenue drop, you have to keep in mind the more shares that get taken off the table, the higher their earnings per share will be at the end of this quarter. So we've got some earnings coming out soon, and I can't wait to see them. But nonetheless, let's get into these discussions and just drop it.
I think some of these valuations are out of hand. They're being driven by Fed liquidity, and I think they're going to be disappointing.
Like which ones? When you say that, what kinds of stocks are you looking at?
So we've been trimming Microsoft. I talked about it last time I was on the show as well. Even though it's at an all-time high, it's actually performing in line to slightly below the market for the past month. It's trading at 10 times sales. It's a $1.5 trillion market cap. Expectations have not come down at all. Earnings are expected to be up 20% this year, 10% next year. If we do end up in this very low growth world, which will support low interest rates and therefore support the multiple, I'm not sure they're going to hit their numbers. And a stock like that cannot afford to miss numbers at this point.
Wow. Just called one of your favorite stocks overvalued. You love Microsoft, Pete.
I do. But you know what? I also trimmed, and I actually trimmed this morning, but I still hold a majority of what I actually have.
No,
in
you
terms
trim
of options.
Microsoft
I do not
too.
And I think Microsoft, I think that it is maybe a little bit in front of itself, but that's not to say it's why I only trimmed. I didn't sell it. I still think that there is upside to this stock. I still think that they're going to be able to surprise people when the time comes, when they deliver on some of the numbers that have happened. When you look at what's gone on throughout this whole COVID situation, obviously Microsoft has been one of those go-to names. So I think there's a lot of reasons to stay excited about Microsoft. And again, this is another one of these names where there are so many different verticals for them to make money.
I got Joe Terranova the other day telling me that he took profits in Amazon. I got Bryn Talkington a few weeks ago telling me that she took profits in Apple, of all things, sacrilegious to many. I've got two people now today telling me that they've taken some profits in Microsoft.
They have to look at these things in the context of the rest of their portfolio and like their overall life situation. Like, how much exposure do you want to have to one company, given the fact that literally anything can happen to any company on any day? So I don't even think you need to have a fundamental change of opinion on Apple or Microsoft. If it's a $1.5 trillion stock and you own it in lots of the mutual funds you own, and then you own the stock as an overweight on top of that, and it grows to be so big, you just have to ask yourself, like, am I overexposed, even if I love the company? So I think what Pete said is right. This is not just about how you feel about Microsoft's prospects going forward.
I would make a point about Microsoft that's unique. It is the only stock I can find that finds itself in growth indices, and I'm an indexer, so I'm rules-based. I don't have an emotional opinion, but I can tell you it's the only name that sits in a really boring index that is a dividend play like OUSA, but it's also the #2 holding in OGIG, which is a growth mandate. Show me a stock that does both. You can't find one. And that's why it's an overweight, and I haven't sold a dime of it. And I'm going to stay long right through the next 2 years.
Market somewhere, well, it is in cloud computing. I've been telling you this for weeks, but even I didn't realize the full extent of it. The full extent until I read Microsoft's update on its Azure cloud services this weekend. And the numbers, they knocked my gold toe socks off. Listen to this. Quote, we have seen a 775% increase of our cloud services in regions that have enforced social distancing or shelter-in-place orders. You heard me. 775% increase. It's not just Azure. Microsoft points to a, quote, significant spike, end quote, in Teams usage. That's that collaboration platform, which now has 44 million daily users. Last week, those users generated over 900 million meeting and calling minutes on the Teams platform every day.
Well, welcome back, my passive income investors. I like it. I want you to keep in mind what we're going to be discussing are not these companies' fundamentals. I could tell you they're great. I could tell you that nobody knows where they're going. I don't want to go down that path. You're welcome to do your own homework. I want to just touch on the philosophy of how I feel about these companies. And as some of these CNBC talking head investors have mentioned, it is more about the diversification of your assets. Because the thing is if you hold Microsoft or Apple or whatever, and you decide to sell it on this current rally, tell me what you're going to buy out there that is better than this. Literally, this company has so many growth prospects going for it. They have all the money. They have hundreds of billions. Facebook has got $50 billion in the bank. Apple's got over $100 billion just lying around. They have enough money to survive the next few years, if not 5 years, not bringing in a dime through the door tomorrow. There's just so many things to be so impressed by these big stocks. And a lot of people will take their cash out and then think they're going to be getting ahead by putting it in something like a Nikola because it has more hype behind it. And it really seems like the hype stocks are the ones that are taking over this pandemic. But if you have zero exposure to these companies, you are not benefiting yourself. As I've mentioned in the past, if you have zero exposure, I don't care what the price is. You need to be buying these. And to give you an example, because a lot of people are like, oh, but what if it turns down? So using Facebook as an example, I want to really quickly talk about time horizon and risk exposure, because if you're like me and you're in your late 20s, early 30s, you have 30 years of investing ahead of you. And to think about this volatility today is absurd, even going out 5 years from now. Seriously, if you bought Facebook at the top of the market right now, come back to me in 5 years and tell me it was a mistake. Tell me if you even worried about these dips that it took, because I bought my girlfriend some Facebook here when it took the first dip at 235. Mind you, we were also buying the dip down in the 150s, and she's kind of building up her cost average. But her being as frugal as I am, she watched it drop more from where we bought it, and she says, why didn't we wait? And the thing is we don't know. You guys need to start reprogramming your neural network if you ever want to be rich with stock market investing, because if you do not get excited when the stocks go down and you get depressed, I mean, you really need to start rethinking this. And to give you an example, and I know Captain Ryan from the Independent Investor will attest to this, when my portfolio went from 150,000 almost to 100,000 on that major dip when this pandemic hit, most people would probably be freaking out and selling their portfolios. And what was I doing? Running around more excited than anybody I ever met in the stock market at that time. Because what happens when you're able to accumulate shares at a lower price and you look at your time horizon being another 30 years of investing, do a compound calculation on your financial independence retire early journey. And it was pretty easy 3 months ago to look at something like a Microsoft, an Apple, a Clorox company, a PepsiCo. When you watch those dividends hit 3%, 4% yields, and you know they're going to keep paying it out through these pandemics. Now, obviously earnings could get hurt, but the fact of the matter is, guys, you're not going to be worried about this 5 years from now. It's like looking back at the 2008 financial crisis. Do you look at that financial crisis and let it dictate your current investment philosophies when you're buying these kind of companies? No. So you have to keep looking forward and not get caught up in these macro decisions and keep accumulating shares. Now, if you are somebody that's later in life, you have large exposure to these tech companies, yeah, I don't think there's anything wrong with scaling them down, but do not get rid of these, because what are you going to buy? There's nothing else out in the market that is comparable to the growth rate of what Microsoft is doing right now. Now, sure, at a 32 PE, maybe a little overvalued, but you can't compare that PE to something like a Nikola, a Netflix, because for some reason in this pandemic, all the hype stocks have been getting all the attention, even though the companies make $0. In fact, I'm going to be making a video on the first swing trade I have ever attempted in years. And again, guys, for me to take on that kind of assumed risk with a large portfolio of blue chip stocks, for me to take a big ding on that is barely going to be a blimp on my radar. But if you've been new to investing and you're more focused on companies like Nikola and using your line of credit to do swing trades like I am or something like that, you are taking on too much presumed risk. You need a solid portfolio of blue chip companies before you start making really stupid speculative decisions, because honestly, at some point or another, they're going to turn the other way. They're going to slap you across the face and it might turn you off from investing forever. But nonetheless, are these tech giants overvalued? In my humble opinion, it currently depends on your exposure to these companies, your time horizon, because realistically, if you are later in life, I don't think there's anything wrong with trimming some profits off the top. I would not fully liquidate these positions. That is just way too risky. When you have all these big companies like BlackRock, Vanguard, all the major ETFs funneling endless money into these companies that have bank accounts that can pull so many shares off the table, even if their revenues drop massively, their earnings are still going to be up, guys. It just seems to be the way it works. And I'd love to know what you think in that description below. But I look so forward to my next video where I'm going to share with you my first ever swing trade off a line of credit, which I would have never done again unless it was for circumstances just like this. But consider slapping that like, stay cool, stay awesome, and I'll catch you tomorrow.